Welcome back to Asset TV's View from the Floor. I'm Jillian Kemmerer, today joined by Joe Davis, president of Stonebriar Wealth Management. Joe, always a pleasure to have you on Asset TV. Seems like markets have moved drastically over the past few years. Give us your state of the union. Where are we today?
Sure, it's an honor to be here, Jillian. Thanks so much for having me. So it's been a great, strong rally to start 2023 thus far. And I bet if I were to ask some of the traders on this floor, they probably didn't even see it coming, especially when you look at the NASDAQ and the technology sector in particular. So as the famous Yogi Berra said, when you reach a fork in the road, you take it. And so this really is a pivotal point right now. Do we continue to see how this rally goes, or do investors take some chips off the table and take an easy 4 to 5% in a cash equivalent or bond? So looking forward to the end of the year, that's the real question.
Now, as we were preparing for this interview, you so eloquently put it to me, it's a tale of two tapes. So let's start with this bull case scenario. What is the evidence that roots this potential landing?
Sure. Well, if you look at history, right, something that is often overlooked by the bears, and if you just take the technicality out of it, in the last 53 years, there have only been two occurrences where the market has been down 2 years in a row. And that was in 73 to 74 and 98 to 2000. So we are sitting here right now over 500 days since last reaching our highs. So that's over 20 months. So just to keep it overly simplistic, there is this notion in the market that when things get screwed up, they often fix themselves moving forward. So that historically is a point on the scoreboard for the bulls here. Looking forward, we're down pretty badly from the highs, and it's been a while. So if what goes down must come up, we're getting closer to that point in time.
So much of the discussion of the equity rally has been centered on the resilience of the U.S. consumer. Yesterday, consumer confidence numbers came in a little tepid. We're seeing rise in, let's say, auto loan defaults, credit card defaults. How long can the U.S. consumer power this economy?
Another very good observation, Jillian. When unemployment is this insanely low as it's been, it could still go up a couple of percentage points. Unemployment would still be very, very low. With that as a backdrop to the U.S. consumer, even with these signs of slowing, it's hard to say that the consumer is in rough shape. It's many unprecedented things have happened since the pandemic, and a low unemployment rate seems like it's one of those. And it's certainly bolstering the purchasing power and buffer that many of Americans and the U.S. consumer have.
Another major thesis regarding this bull case is around artificial intelligence and the role it's played in bolstering, let's say, the Magnificent Seven and the tech stocks that have been major ground forces in this rally. How long can the AI party continue realistically?
So if artificial intelligence is the next leg of the dot-com rally, that significantly raises the bar for valuations, and in particular for the tech sector. So remember, there are 11 sectors in the S&P 500. One of those makes up 28% of the entire index, and that being technology. And as you mentioned, 7 companies are the mega caps that make up most of that sector. But at the same point, if the potential for AI is here to stay, and we start to see its efficacy in its everyday usage, it's going to affect the entire stock market and give this runway a little bit more time and distance.
Joe, we'd be remiss if we didn't touch upon the fact that there are geopolitical tensions occurring throughout the world, whether it's the continued war in Ukraine or the little bit of wobble we've seen in China. We're seeing it economically, but of course there's continued pressure and focus on Taiwan. How do you think this plays into markets going into the second half of the year?
So over the past 7 years, like you said, there has been this trend of de-globalization. Maybe pinpoint it back to President Trump taking a more hardline approach with our diplomacy towards China. Of course, the Russia-Ukraine war, and Taiwan and China, of course, is another example of geopolitical tensions. And by no means has there been a ceasefire in Ukraine and Russia. And we're not all playing nice in the sandbox yet, but there is this growing notion that it might have worked better before these tensions arose. And that will be a tailwind on US stocks because, look, I know that globalization can be a hot topic. It's a political issue. But if I were to take our political hat off for just a second and say, globalization yields low inflation and higher profits. And for that reason, the market likes globalization. And I know that's a very simplistic way to put it, but if we start to see this consensus, things were a little bit better before all this global conflict started. That's going to be a nice tailwind for markets.
Stonebriar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. It is not a guarantee.